Have you ever heard someone say, I don't want to earn more because I'll move into a higher tax bracket and lose money? That sounds scary, but it is usually based on misunderstanding. Welcome to day 31 of my 1-day finance challenge. First, let's talk about gross and take-home income. First, your gross income is money you earn before taxes and deduction. Your take-home income is what actually arrives in your bank account. If your salary is $5,000 per month, you probably do not receive the full $5,000. Some money may go to income tax, payroll taxes, insurance, retirement contributions, or other deductions. That is why your budgets should be based on take-home income, not gross income. Now let's talk about taxable income. Next, taxable income is a part of your income that is actually taxed after allowed deductions. A deduction reduces the amount of income subject to tax. For example, if you earn $50,000 and have $10,000 in deductions, your taxable income may be $40,000. This is a simplified example, but the idea is important. You are not always taxed on your full gross income. Now let's talk about tax brackets. A marginal tax rate applies only to the next portion of income, not to everything you earn. Imagine the first $10,000 is taxed at 10%, and the next $20,000 is taxed at 20%. If you earn $30,000, only the income above $10,000 is taxed at 20%. The first part still gets taxed at the lower rate. So earning more does not suddenly make all your income taxed at a higher rate. Now let's talk about deduction and credit. A tax deduction reduces taxable income. A tax credit reduces the actual tax you owe. So, a $10,000 credit is often more powerful than a $10,000 deduction because it directly lowers your tax bill. Now, the takeaway today is taxes affect your budget, investments, and financial decisions. But do not fear earning more because of tax brackets. Understand how the system works and focus on what you actually keep after tax. Tomorrow, we will learn why retirement saving is really a game of time and compounding.